Okay, we're going to go again. So over the years, I've really struggled to sort of steer people into what I think that counts. Well, not just what I think counts. What the basic maths of making money counts. You know what counts. And as always, with a trend approach, it's about adding to your winners, being heavier in what's working. That's where the money's going to be. You're going to end up with big outsized winners compared with losers. With a swing approach, what I like to do, swing approach is basically not the primary trend. We're not sitting through all those pullbacks. We're just trading the up move of the trend. Now, there's quite a few pointers here what I'm going to jump into again. But I think people confuse. Today I've had so many comments on this again, and every time I do a swing tutorial, I think how simple can I make this? But no, I still just can't get it across. So what I want to do now is just I'm coming at it another way again. It is really basic stuff. So what we're trying to do, secondary trend, buying a pullback. Now, buying a pullback, there's going to be a swing point. Buying a pullback could be a pullback into a trend. So what I've just done here is I've shown you the trend bracket. How do I get that bracket? Well, and how do I get my entry, and how do I get all of these? The levels, what I'm going to look at is the previous high, the swing high, the pullback low, the swing low. Now, to get this target move, first things first, it's just a pullback. It's just a pullback, nice orderly pullback in a stock what wants higher. Stock what has all the characteristics of a stock what's just in a normal pullback, and it ticks all the boxes for what you like to trade as well. It's certainly I don't have a secret code for this stuff. So it's just a pullback. What about this target? It's just a target. It's a high probability target. I used to do a half measured move. What's a half measured move? Swing high minus swing low, tag it on, divide it by 2, you get half, tag it on the top. This is a third measured move. Swing high minus swing low, divided by 3 plus the high, just tag it on the top. It's just higher, the closer the target, the higher probability the move. You'll also see, we'll just throw percent. Oh, it's 10% on this large cap. It's 10%, and very achievable. But another part of the scenario is, before I jump onto that, so we've got a high probability target from a pullback. Why is this pullback hitting the screen? The GTRS is tuned so everything has reward to risk towards this third measured move. So we'll have 2 to 1 or higher towards this. So we're not trawling through all these 1-to-1 scenarios. The reward to risk is built on, the target minus the entry divided by the entry minus the stop, and it's got to be above 2. Reward to risk 1 to make 2 or more. Dead simple stuff. So I've condensed down everything I do into just these high probability pullbacks in uptrending stocks, the structurally best uptrending stocks, and they have reward to risk. That's the signals what will come up on the end of day dash on the signals dash, with the ones what have got above 2 reward to risk. On the end of day dash, they'll have a fundamental threshold under them as well. So that's my fishing grounds, prime fishing ground, and wider area being the signals dash. So entry tactics. Again, I've got I like to keep it super simple. If I wanted to get in this one today, with it gapping up, I would have put an order down near the previous day's high, because that's quite a high probability area as well. On a day like today when you get read across, yeah, just left the station. I don't chase anything like that. It's not my way of, you know, day traders love this stuff, but it's extremely hard to get any kind of reward to risk or consistency chasing read across gaps and stuff like that, you know. Yeah, it looks fantastic today, this one, doesn't it? But, you know, do it 100 times, you'll lose money hand over fist. But so this entry I've got here is it's dead simple again. I used to buy 0.5% above the daily pivot. What I'm doing here is I'm just calculating the daily pivot from the swing day. So, you know, the setup day. Daily pivot, anywhere between the daily pivot and the previous day's high, just above the previous day's high if you're waiting for a break out of that. It's just an area. It's all fair game. I've just boiled this down to a real simple order I put in the market. Daily pivot blended with the previous day's high. So I just add them both together, divide them by 2. You can do the dampened one where you actually do the midpoint of the setup stick as well and throw that in the mix. On big range days it will sort of move it quite a lot. On short range days it won't even affect it hardly, but it'll just give you an area, you know. I said to I'm just going to check them up and running. I mentioned to James today, yeah, you know, the more dampened version, on those days where the market opens down, it can be a little bit more beneficial for you, tied to stop. On a frothy day, it could work against you a bit. Don't get, you know, it's not about that. It's really not about. This is so besides what we're trying to do here. It's just an entry, dead simple. I like to have reward to risk in my entries, don't I? You know, it builds a little bit of failure into what I'm doing. So with that in mind, I'm going to steer you to the things that count. I'll just go through this again. The bracket, the swing bracket, is the target move, and the target might be different than this. Say it's a big deep pullback, that I will adjust the target to back to highs, you know, because deeper pullbacks are less likely to just break straight through. They've still got reward to risk, you know. But on this example, it's a third measured move. The bracket is the third measured move minus the entry for the swing. Gives me the reward to risk of 1. If it was a trend, it's going to be in a thinner stock, isn't it? In most cases. If it was a swing trade in a large cap, a pullback in a large cap, I would take it the more liquid swing route. You know, say I was buying a pullback in a large cap, but my view was to hold it for a trend. Well, I would still go the more liquid route, unless it was a very small reward to risk and I wanted to give myself more room. So, you know, there is methods in the madness. Having a wider stop on a thinner small cap stock with a wide spread, it's going to make sense for slippage purposes, you know, because I plan to build on those anyway. If I'm buying a pullback, I'll be adding a higher high, so it doesn't matter to me, you know. I'm going to be building my position with a wider bracket. So with that in mind, we go back to swing lane. What we're trying to do here, rotate swing trades. Always the option to hold for a bigger move. Always the option to add and trail and just throw them in trend mode. You know, that's where the big money is in this game. It really is. Swing trading is patchy. I've tried to set my screens up so the secondary trend on the screen, so only the structurally best stocks throw swing trades, swing entries, and basically that means you're not going to see them for some time. Now, I get messages off overactive investors all the time saying, "Look, there's no swing trades here. I need something. I need to do something a bit more active here because this isn't for me. It's, I'm bored." And guess what? If you follow Mark Minivini's style, most of the time it's not on. If you Dan Zanger, most of the time it's not on, but when it's on, they go heavy and rotate until it stops working again. Feedback from the portfolio will basically dictate that. So it's sporadic. Sometimes it's great. The markets does 3 or 4 pullbacks in a year and has really good swing periods. Sometimes it's 1 or 2. Sometimes it's just a bear market, So the key is having the tool and knowing how to address, how to implement it. Now, this is my hardest thing to get across. People wait until everything's working fantastically well, and that's when they want to start swing trading. It just doesn't work like that in my world. I trust the screens. I trust that I'm taking the best opportunities, and I do not know which is going to be a winner. But I've got my risk management in place. I'm dangling toes. I'm getting a few bitten off. But if I'm building on success and I'm getting those winners and I'm trailing break evens and adding more, and the market's in that quiet sort of melt, and it's not just we've not got news bombs hitting the tape all day long and destroying your swing trades, like gap risk and all that kind of stuff. If things are acting well and some targets are hitting and you're rotating profit, and you're holding on to the ones you want to hold on to, and things are working, and it just snowballs, and you just and if it rolls over, you lose 5 toes, and obviously the market's telling you something. So the market is always we don't have a day off our day jobs and basically go, right, today's the day we want to trade because I've got a day off work. It doesn't work like that, It's about turning up and just we do business at the right hand edge, and we plod along and we go, oh, things are actually working now. There was no prediction in that. I can predict that the market's in a pullback, and I can predict that bull markets follow bear markets, and I can predict that this market looks really set up. This first pullback could be a slingshot into the next potential bull trend. I can predict all that, but where the rubber meets the road and at the right hand edge, that might not be today or tomorrow, even if we get it right. That could be three months down the line. But turning up and taking my setups as they hit the screen, when I have heat, my risk is managed by how bullish the index trend model is, how much heat I have in the market. I'm always watching my trend trades, how they are acting. I like to throw things in a watch list, even if I haven't got heat, just to see how they're acting after the setups go through the end of day setup. And we just feel our way along. There's no predicting in this whatsoever. You predict all you want, but it doesn't mean nothing, does it? It really doesn't mean nothing. At the end, we just build on success, and the market gives us the feedback. Hindsight don't pay the bills. It never will. You have to put money to work, and basically, the market will give you the feedback. It will tell you if you're doing well, or telling you if you're taking too many trades and not building on success. You've got 3 what are still plodding around and not leaving the station, or 4, and you keep adding more, and you're just adding more risk without any results. So that is the real sort of what counts in this game, not predicting that the market's good, so it should be good for swing. It doesn't work like that. It's the tail wagging the dog, isn't it? So back to basics. What I've done is back to the old. We've got all these real basic sort of levels in here. What I work off, I want to pull back with a swing point will happen in every reversal. I'll just note that every setup will follow this. Every end of day daily setup, the swing bar here, the swing point, the high of the lowest stick, is the first line in the sand the bulls break. They break it on this day, intraday. That's the first intraday attempt at going higher. End of day, the first end of day was that day. But every setup you see anyone take, will follow this. This will happen in every reversal. There will be whipsaws. As you can see, there's one here. Bang, came lower. So having reward to risk filters out a few whipsaws, insulates you a little bit. You're only taking the ones what are pullbacks with reward to risk. That's how I work. It's certainly not a secret code. What is the keys to the kingdom? It really isn't. So when it comes to position sizing, I've just put it in here. I've just got to put 500 in there because I've got some swing high, swing low. I've got high, low and close in here for the pivot and find that entry. I've got the blended entry in. So 1299.83. So next thing is what I'm going to show you is that this is the question. When we did the swing testing, I just position sized everything for the stop. The reason being, I didn't want to complicate people too much. I've had many comments on this. You used to do it like this, but now you do it like that. No, I've never changed the way. I've got multiple ways of approaching this. If you go back to the momentum swing, I talk about you could set your stop at, you could divide your target by 2, set your stop there, and then it's all going to be like you could still put your stop here, or you could leave it for the looser stop. It's all going to be about reward to risk, and this is what I'm trying to steer you towards. But what I'm trying to insulate people from, because this method here, I use 0.5% risk on swings, and if you basically just put, well, I've done it for you actually. Let me just show you. So I've just put entry and stop here, 14.20. Let me just price input that. Override stop 12. No, I'll put it on the other page actually. So what I've done is 0.5% R equals initial risk. So R is always initial risk. So though there is 0.5 R, if you're trailing a loss and it's only a half loss, you're going to be 0.5 R, aren't you? But no, initial risk is always going to be 1 R. So it's always going to be profit divided by initial risk, what gives you your R multiple. So what I've done here is, that should say bracket actually, rather. Risk equals 0.5% at stop. So entry, 12, same entry on both. This is the stop, same stop on both. I'll put the stop. Sorry, done that wrong. Let me just... Well, no, I've done it right. I should have done another example actually as well. Start again. Right. Entry, stop, entry, stop. This is the swing low of both. So what I've done on this one, I've risked 0.5% of stop. This is the problem. Look at the weighting, 20% weighting on account doing that with 0.5%. So literally you can see that, 0.5%, you can't basically, well, you can do that if you've got a lot of money in a spread bet account. and you can use guaranteed stops. You can do that, but that's a huge amount. Does anyone trade like that? Does Minervini trade like that? No, they don't. Does, William O'Neill trade like that? Well, yeah, he does. he goes on, 8% stop. He likes 4 positions of 25%. That's how William O'Neill used to trade. Really aggressive in only the cancelling stocks, true cancelling stocks. What he liked. He used to like to buy and add fast though. He didn't like to just take a 20% position, whatever. So it's a difference, isn't it? The even weighters in the US stocks with the very liquid, tight liquid spreads, they can be a bit, we can't do that in us. Basically, we haven't got enough merch to trade like that. A lot of our best growth stocks are going to be very illiquid, very, very thin. Our swing stocks, still we don't have many. In any good market, you've got like 10 or 12 swing stocks doing the business. But we've got lots of US ones we can trade. So the way I come at it is I flip it on its head and I show the lowest possible ways of doing everything here. And what I do is about 500. What I do is I position size for the bracket. So look, entry minus. It's just basically I'm saying this bracket here. I'm going to put that stop distance in. It's 127.67, and basically, if you put that here, entry minus that, it will give you that 1172.17. If you get it exact. That's all I'm doing. I'm just saying that's a safe distance. Now, if I'm taking a trend trade, that's what I'm doing. I'm saying this is my stop distance for my pullback into a trend trade. That's all I'm doing. But I don't want, because I've got a target on it, I don't want all of my trades to just drop down and stop me out. Now I've got different ways of trailing. In a good market environment, in stocks I want to hold for longer trends, GTRS stocks, say, I won't use this stop. I'll say I'm in the area. It's quite a wide bracket. I've got room to breathe here. I'm buying a pullback on this because I want to add at highs. Now, if I don't want to add at highs, I'm going to be a little bit more cute. I can be wrong here and take the trade 3 times. So basically, this is the difference. The weighting is a 4.8% weighting doing it that way, putting that bracket on. Now, I put my stop here on the swing low. So I've got the entry, the swing point low here. And I already know that I need 3.922 lots because I've just position size for it using the bracket, 3.92 lots. So all I did was I put that data in here and it told me what that risk is at my chosen stop distance. It's 118.8936. So by putting that in there, 1R is now 119. Now, if I take every different position this way, that will be a different number on every swing trade. So if I take 15, some might be £70, some might be 100 and none will be more than 250 because I'm targeting 500 and there's got to be 2 to 1 reward to risk in every position. but as you can see, this is 4.2 to 1 or something. You know, there could be any combination between 2 and wherever, you know, 8 maybe. Reward to risk on these. So an 8 reward to risk would be about £50. A 4 reward to risk would be about £100. But if you average it out, you'd be at around £75. And what I want to show you here is, this is method 1. The huge risk, it's, you know, the risks I'm trying to steer people away from is the weightings, you know. Fixed fractional with a tight stop is going to give you a really heavy weighting, so you can turn it on its head and target an even number and just have a different risk on every trade, but it's going to average out over time. You know, they're all 119 here, you know, but this could be 50, this could be 70. There could be lots of higher ones, lots of lower ones, and all these 15 different fit positions together could average out at 119. So that's what I'm doing, you know. I'm keeping those weightings, the gap risk from a 50% haircut. Let's go back into it. You know, what are the real risks here, you know? Here we are, bankruptcy risk. It's going to be like 10R, isn't it? It's going to be it's going to be everything, isn't it? £5,000. It's going to be 5% of account, 4.8% of account. 50% profit warning. What's that going to cost you? Well, you know, it's going to be 4.8R. It's going to be 2.4% of account. You know, these are just a little bit of a paper cut, you know, a little sting. That's all they are. This, you get whacked a few times by the, you know, risking 500 at that tighter stop area, that 1269.5. You know, that 20% weighting. You know, this is disastrous, you know. It's bankruptcy risk 20%, you know, 50% haircut 10%. You know, there's no cushion is what I'm trying to say from that entry. So that's why we don't want to go that way. Oh, come back one more than I should have done. So we don't want to expose ourselves to that. It's not about taking huge risk on entry. It's about rotating R. And this is what I'm trying to focus people on. All this swing stuff is just trying to show you what all this stuff's in the site. It's real basic stuff, and I think people get lost in the technicals and magics. You know, there is no magic stop area. It's a reward to risk scenario. It's about your average. It's not about how often. Well, it is about how often you're right. Obviously, if you can't be right, you're gonna, you know, if you're wrong 80% of the time, the market is telling you it's a bad market environment for swing trading, or, you know, basically you're doing something, your methodology is flawed. It's one or the other, isn't it? Say your methodology is not flawed, but you're having long strings of losers, not building on any success. You know, before you get into a hole, you will know this. You know, the data will be there. The ones what you're taking won't be moving. You getting stopped out of everything. You know, the market will give you the feedback, but it's down to, you know, there's a reason I haven't got how much profit, and it is down here somewhere. I've got it somewhere in the sheet. I don't know. Just to move over. I don't think I have. It's not on it's on the end of it's on the yearly sort of update. But sorry, I can't remember the name. The returns dash. It's on the returns dash on this sheet. You know, it tells you what you're making. But you know, profit, loss, you know, gain to pain. So what's the gain to pain? You know, we're gaining twice what we're losing, basically. So what's the average R of all trades? 0.7. You know, that is really good. You know, every time you're rolling the dice, you're making money. You can see the win ratio is 33%. How many winners are there? I think I put 3 targets and 2 close to targets. So 5 winners, and then losers, I threw 1 with slippage in. Did I throw 2 with slippage in? Yeah. So I threw 2 what slipped the stop, 1.6, 1.1. I just threw a little mix in, and basically, you know, in a good market environment, you go through a phase where it seems like, you know, you're printing money. In a bad market environment, it'll seem like you're really struggling, and you know, you might start messing around with your winners and not getting your targets, and just overriding things and affecting your own expectancy. You know, trade tampering. You might start trade tampering, but you know, we're all going to do things what aren't really good for the longer term results. I do. Everyone will, but the less the better is basically what I'm saying. And just letting things. This is without adding to anything. This is just banging in that generic target, not trailing anything past the target. Just, you know, obviously we can't trade like that because that risk is just too high. So if you look at the numbers here, you know, anything in pounds, you can kind of ignore that. But everything else, I'll just flip between the two. Only the pounds move. The loss in pound and the wins in pound, the average gain. Everything else stays the same. So basically, you know, just throwing it in that way, rotating 15 trades at that risk, targeting that target. You know, that's what I'm kind of showing you here, and it's about average win to average loss. You know, average win is 3.8R there. You know, what you might find is, I mean, if you've got lower reward to risk trades, that's going to come down, but you might be right more. You know what I mean? There's another little trade-off. What I always say is, you know, lower reward to risk trades can be higher probability. You know, it's pretty standard that the best trades are actually quite hard to catch. So sometimes shallow pullbacks work fantastically well in stocks what are really in play, and they have lower reward to risk. It just you know, everything's a sliding scale. You notice the spreadsheet's now struggling. Everything's a sliding scale in the markets, in methodology. Are we coming back on here? Not what I need really. There we go. So yeah, you know, all the stats are the same here, just the numbers are different, and I try to steer people away from doing those really. The good thing about what I'm doing is, no matter a tight bracket will always have more weighting and more gap risk. But so long as it's a pullback with reward to risk, and you can look at it and go, and you look at the weighting and look at that gap risk. My big issue here was, you know, people are too aggressive. Newbies are always too aggressive. Everyone's too aggressive. I was super aggressive, but I started trading, and then I stopped trading for 5 months in 2011, and I really fine tune my swing risk and how I sort of my trend risk and everything was fine, but it was the large cap stocks with the higher prices and getting swung around and volatile swings. That's where I sat. While the market, I thought the market had left me behind at one point. It went back up and then it came back in on this long pullback. And I had it all in place. And I've got all the pieces of paper in my drawer here. I might actually bang them into a spreadsheet like this. And, those pieces of paper taught me a lot. They taught me that my biggest winning months were also my lowest win rate months, which is crazy, I know, but it was just how it was. But I used to run my winners on a trailing stop back then, and this is trying to get something towards a target, and everyone can trail them how they want, can't they? That's part of your own department, how you trail your winners. But I'm just trying to build some kind of positive expectancy into the GTRS and into this, and giving people the levels I use, because on entry everything's pretty everyone knows how I do it. This is how I do it. I've got multiple ways of it. It's the management and everything where it changes. What am I doing with this trade? Am I going into a trend? Am I giving it more room for this reason because I want to basically it's a deep pull, but I've got lots of room. I can give it a bit of, you know what I mean. But if I'm just pure swing, rotating into profit, rotating in profit, this is very important. The risk to reward, the gain to pain, the average R, these simple things. You can see the Kelly barometer's only just positive on what I've put in here. What did I put in? 10 losers, 1, 2, 3, 4. Oh, it's here, isn't it? 10 losers, 5 winners. What would happen if those 10 losers were all in a row, and then it was 5 winners? You know what I mean? It would give exactly the same result, but what would it do to your head? Now, I've had messages of people who've had 2 losers on the chart and they just go reinventing. I've had people join the site and then leave and see them move to the next person because they haven't done any research or put any you can lead a horse to water kind of thing, and they just haven't. Basically, they just copied a trade, had a loser, moved on to the next. It's really not in the entry. It all comes into it. The setup and the entry and all that. And I tried, the ones I trade are the ones you see on the end of day dash and the signals dash and these screens. But what separates the people who can do this long term? First I'd say it's sitting on your hands. If they're not there, I don't go inventing them. I don't force my opinion on the market again. They're not there. I don't see the swings. I just don't see them. Yeah, but everyone's killing it on Twitter. They're all trading Nvidia. Yeah, but I don't see my pitch. I'll wait for my pitch, and then when it comes along, then I just rotate my pitch because I know my results are real, and I know I'm trading thousands and thousands and thousands of reps of these things, and I've got the history, and I know exactly what I've been doing. I know what a bad market environment can throw at you. 7 losers on the trot, bang! They all come at the same time. Then all of a sudden, I'm posting my swings on Twitter because I'm having a great time. It is what it is, isn't it? That's how the markets work. But if the numbers don't work out at this end, Kelly barometer will tell you whether you're profitable. And obviously you need to double up on these so many times. and you can tune. You can decide. You could say, well, I want it to pay 1% at target. Well, happy day, because I'm not getting as many opportunities what I would like in swing trades. Or you could say, well, I want to take more opportunities, so I'm going to go down to 0.4%. You know, I can take lots of paper cuts. I don't get emotional about any of them. You know, you can fine tune that to your own. I'm just going to basically mix this up a little bit here, and you know, we'll just change the dynamics of it a little bit as we go. So now what have we got there? 12 winners, 18 losers, 40% of the time right. And then all of a sudden you feel like you're printing money, you know what I mean? So yeah, it swings and roundabouts, but hopefully that sort of, you know, the actual mechanics of it is real simple. As soon as you add a trail methodology to your winners, all of a sudden you're gonna start getting smaller winners. But I'd always steer in the direction of, if I'm gonna trail tighter on my winners, and I understand trailing tighter on to you know, as they move out, to get smaller losers. I totally understand that. But if you're going to trail tighter on your winners, a lot of them are going to fall short of the target, just get knocked out. So you'll start asking for really nice linear action out of every stock to make your target. Now, it's a little bit troublesome that it can mess around with your reward to risk sort of setup. But you know, say something goes through your target, you know, and then you start trailing, say, a 3-day stop or something like that, you know, well, happy days. You know, that's where you start to get those 8-10 hour winners. And you know, that's got a lot of merit, is what I'm trying to say. I don't think there's much in the screens today, so I could drag this out a bit. So yeah, getting to that target. And you might say, what about taking some off at the target and then running the winner? So well, yeah, you know, but you know, if you can maybe add to these things earlier as well, that's another thing. You know, you buy your initial, and one really simple way is, if you're buying a pullback, you go, well, I'll buy this much on the pullback, and then if it goes too high, I'll trail more aggressively, and you know, you end up trailing into here and adding more as it goes through the highs. But that really does jump onto the gap risk again. So I've got a method in the site, and I did hide it for years because it's, you know, the opening range, as they go through the opening range, it's my very aggressive. It's no good with IG because of the spreads involved. But when I had direct market access and free trading, I could trade that methodology really well, just with stop limit orders as it went through the opening range high. You know, I knew how many I had to buy as soon as it did it. And but you know, IG, having to move to IG was just like basically the you know, real tight methodologies. It kind of made them really hard to execute. So yeah, I mean, I'll do another video for the site at some. I'm gonna build this out in the site in the swing sort of position sizing bit, and just, you know, give a few, well, go through it all and give all these options, give all these sort of, you know, basically just give all that information again in the site. Hopefully that added a lot more colour to what I did last night. I wasn't having the best night last night. So yeah, high probability target. You can choose any one you want. You can make your own up. You can use a fib level, swing high, swing low. basically pivot area, average out the pivot, the previous day's highs. What I like to do, I like to be filled easily. I don't like to be looking at 5-minute charts. Usually you just have to wait for the spread to narrow to get your fill. Sometimes they gap down, and just on a market open, entry tactics, we've done those before as well, and I know I did a video on those as well. But yeah, that stuff is just real basic stuff. It's actually what happens when I take 10 of these, and how's that going to work out, and then choosing. You'll get the results if you're running up on demo. You'll get the results, and it will tell you what you've got to do. You go, well, I'd be profitable if I just had slightly smaller losers, or if I didn't strangle my winners, I'd be profitable, and then I could rotate. Happy days. I'm taking too many trades against the market. The index trend model's down at 4, and I'm just going looking for swing trades rather than letting them come to me. The structurally best swing trades. It's a lot of psychology in there, isn't there? And just predictions will destroy perfectly good methodology as well. Predicting what should happen rather than just letting the market lead. Right. What gapped up today? I'm just going to quickly fly through these. Just buzz through these, see what's in. Lots of stocks just popping off the lows, loss-making ones, aren't they? It's a sign that the market is definitely trying to improve. Closing highs. Let's fly through these. Beverages. And what I'm talking about there isn't just for my swing methodology, it's for any active methodology where you're rotating positions. The R multiples, the gain to pain, however you want to calculate it, the expectancy has got to add up. Whether you're Warren Buffett, whether you're Paul Tudor, it doesn't matter. Trend followers, Warren Buffett's of this world as well. It's about being about big winners, about being heavy in what's working. Swing trading is in the noise, and it's about trying to sort of navigate the markets without getting hacked to death. That's basically it's a bit more Tomb Raider. Let's fly through these. Oh, look at the end of the Empire Metals didn't half take off, did it? Okay, quick look at the swing trades. I don't think there's much today. Lots in the screen, just not much in the end of day, is there? Not my pitch, I would say, but we'll have a look. Let's just fly through them. I'm gonna have to lots of bad signals. Utilities ticking up today. Bellway, obviously news on that one, causing read across. VMC, horrible action. Yeah, this one turned into, well, they all turn into story stocks, don't they, when they've been on a bit of a run. Got a little base here, a little high in the sky base here again, and then it just basically bumped into that level, came back down on the news, and then 45% plus off highs. Standard. Audio boom, I took the liberty of drawing a base on that, didn't I? And it, you know, a little bit creative, as we said, a bit early. See the swing point, but loads of reads today. Quick look at gold. Quick look at TLT, gapped up. Let's go and have a look at Bitcoin as well. It's gone straight back up, hasn't it? Obviously, I've not got it today. It's probably at highs, is it? Shallow pullback. Yeah, so that's basically what I see today. Not much to see today. Okay. I got a lot done today, and Jamie basically helped me with a load of links what needed setting up in the site, and I've got rid of a few of the share scope links and just put them links to the members area as well, and members joining page, and just trying to get it a little bit, you know, not been able to get my head in the site for a week or so because I've been too ill to do it, but there is that technical swing sort of side, trade management side, what basically hasn't got anything in it. The link doesn't go anywhere yet, so I do plan to fill it out with a bit of stuff like we've talked of tonight. Okay, cheers all.